Hi, welcome to CoMotion Labs Fundamentals for Startups. I'm Yuli Rivera, manager of CoMotion Labs. While we wait for everyone to log in and join us, I'll make a few announcements. Next week, Tamina Watson, immigration attorney and founder of Watson Immigration Law in Seattle, will present the immigration options for startups, current laws, and new developments. All of our Fundamentals for Startup presentations are archived on our CoMotion website under Innovation Training Videos. We have covered a variety of topics over the past several years, so if you find yourself some free time looking to see if we've covered a certain topic, check out our past talks. For our full schedule and to register for future Fundamentals, please visit bit.ly/CoMotion Fundamentals. Also, please subscribe to our YouTube channel and click the bell. You'll be notified of all future live streams. Fundamentals for Startups is funded in part by a grant from the Economic Development Agency. We'll be dropping a link into the chat for a short survey. Please tell us who you are, where you're watching, and how you heard about this event. This will help us report back to the funding and continue to get funded for these events in the future. This year, we are proud to partner with Bluetooth to support Fundamentals for Startups program. See how Bluetooth audio sharing is poised to once again change the way you will experience audio and connect with the world around you.
Bluetooth introduced the world to wireless audio. Calling, listening, watching, making us safer, more productive, more joyful. It's part of the fabric of our lives. Now, Bluetooth will bring us even closer to each other and our world with audio sharing. It will let us share with others our music, our experiences, listening and watching together. The places we go will share with us, enriching our experiences, helping us hear our world. Breaking down barriers between interests, cultures, generations. Introducing Bluetooth audio sharing. Closer together.
Today, Sonia Erickson and Ashley Brown, attorneys with Cooley, are here to present top 10 deal terms every early stage company should understand. Sonia Erickson is a member of the firm's board of directors. She has over 30 years of experience counseling emerging growth companies, established technology businesses, and venture capital funds. Her clients range from early stage startups to larger public companies. Sonia advises clients on a variety of legal and business issues. Her particular expertise is in private and public financing, strategic technology transactions, and mergers and acquisitions. Sonia's counsel to public and private companies in a broad range of industries with a focus on the software, biotechnology, and medical products and service industries. In the last 10 years alone, Sonia has worked on more than 500 venture capital and private equity transactions, as well as numerous public offerings, M&A, structured buyouts, spin-offs, and other complex business transactions. Ashley Brown practices corporate law with a focus on emerging companies across a broad spectrum of industries and stages of development. She has experience with corporate formation, venture capital financings, mergers and acquisitions, and general counseling. Sonia and Ashley will take all questions via the chat. Feel free to ask questions throughout the presentation. I'll now turn over the event to Sonia and Ashley.
Thank you, Yuli. We are delighted to be here today and to present on what we think is a hot topic and for everybody who's thinking about joining the startup world. We have a long history with CoMotion, working with various startups and spinouts out of CoMotion and its prior iterations dating all the way back to the mid-90s. We've been partnering with them. So we are focusing today on on financings, with a particular focus on that first financing, which is really critical to set the terms, which will often dictate and box you in to terms going forward. So super critical from our perspective to be thoughtful about those terms and to get them right. So with that, we've tried to distill a pretty lengthy, comprehensive, complicated set of issues down into a top 10 list that's hopefully digestible in our short hour together. We focused this list based on what, in our experience, based on hundreds of conversations with founders, tend to be the top issues that founders care about and focus on, and in fact, later through the journey of a company, really matter that you get right. So with that, I'll turn it over to Ashley to get us started on the terms.
Great, thanks so much, Sonia. So these are the top 10 deal terms that we're going to be walking through today. As you can see, the first 3 are related to raising money through convertible promissory notes, and the last 7 are going to be related more so with raising money in exchange for equity. So we'll kick off with the first 3. First is the maturity date. So convertible promissory notes are loans, and so like most loans, they have a fixed maturity date at which point they're going to be repaid with interest. And maturity dates can vary, but typically we'll see these set at about 12 to 24 months after the closing date. And when you're thinking about what to use as a maturity date for your note, I would look at it as a way to set expectations for investors as to the likely date for closing your next equity financing. So in general, a later maturity date can be better for the company, but kind of just think, when is my next equity financing likely to come? And that's typically where you'll set the date. One question we sometimes hear from companies, what if we get to the maturity date and there hasn't been a financing yet? I would say the most common solution there is that the company reaches out to the investors before the notes mature and will ask for an extension. Of course, there is technically the option of repaying the amount, but a lot of times when companies are raising through notes, they may be a little bit more cash poor, so that's not ideal. And then, of course, defaulting on the note would not be ideal for the investors to push that and push the company into bankruptcy. So moving on to conversion discount. In order to make a note investment more attractive to investors, a note is generally going to convert at a discount. So a discount is simply a percentage discount on the price per share of stock that's sold in a financing. So for example, if you have a note that has a 20% discount and your company sells shares of preferred stock in its next financing for, say, $1 per share, then the outstanding balance of that convertible note at the time of the financing is going to convert into shares of preferred stock at a price of 80 cents per share, because that's a 20% discount off of that $1 per share price that it's being sold at. Typically, we see conversion discounts at approximately 20 to 25%. And generally, the purpose of a discount is so that a note holder will receive a benefit that's relative to the equity investors that are putting in money at that preferred round, to recognize the added risk that that note holder took by investing earlier on into the company. So without that discount, the note holder would be converting into shares of preferred stock at that financing at the same price. And so that's just not as attractive of an investment because it doesn't account for the risk that was taken. Okay, so moving into valuation cap. So the valuation cap is essentially the maximum value at which a note is going to convert in the next equity financing, regardless of the value that gets agreed to by the company and its investors in that round. So a valuation cap is typically set up such that the note holder may convert the outstanding balance of their note into shares of stock at the lower of either the price that's calculated using that valuation cap or the discounted price per share. And if there's no discount, then just the price per share that's paid in that round. So for example, if you have a company, or if you have a note where there's a $3 million valuation cap, and your Series A investors decide that your company is worth $6 million and they're going to pay $1 per share, that no is going to convert into equity as if the value had actually been agreed to at 3 million. So that's an effective, price of 50 cents per share, meaning your investors getting twice as many shares as your Series A investors, but for the same price. So that's the advantage. And the purpose behind a valuation cap, again, is kind of to account for risk, and it helps to reward early investors where, maybe your valuation jumps significantly, 5 to 10 times between the time of the no and the time of the financing. And that cap allows them to be rewarded for that risk. And when you're thinking about where to set your valuation cap, a lot of times, like we frame it as, thinking about what is the company's current valuation. And while it's not technically an exact valuation, that's how a lot of investors and companies will kind of look at it, and that's how it often gets negotiated.
So Ashley, just jumping in. So one of the most common questions we get from founders at the beginning of discussions about a financing is the structuring question. So what vehicles should I use? I've heard about convertible notes, I've heard about safes, I've heard about priced rounds, Series Seed. So which one should I use and why? I think the basic answer is that I give is, well, first of all, you should ask investors what they prefer, because a lot of the game here is getting money in the door. And so if you have investors that have a strong preference for one over the other, our advice is typically to listen and to be open-minded and flexible about the structure. That said, it is very often the right answer for the first round of financing to use a convertible note or a safe. And we haven't covered safe here just because of the time, but safes operate very similar to convertible notes. But use a convertible note safe structure because they are fundamentally flexible on valuation. And valuation is one of the hardest things to peg, as you can imagine, for a brand new startup company with an idea, hopefully some great IP patent portfolio licensed from UW or somewhere else. But it's really hard to benchmark in the market exactly what the company's worth. And as you negotiate with investors, it is the $1 million question, is what is the valuation and what should be? And convertible notes essentially are a way to punt on that question until you get to a larger round a little further down the road with maybe a little bit more tangible, measurable progress that investors can use to actually peg a value. So that is the most common reason that we see convertible notes being a good mechanism to kind of bridge that gap of valuation uncertainty. And even if you're negotiating the valuation cap, as Ashley discussed, as sort of this alternative formulation of a valuation that would kick in as a lesser of in the conversion, it still doesn't fix the price. It's still, there's some float in it because of the discount. So the other reason that convertible notes can be a little easier to work with as a brand new startup is they're a little bit more flexible and easier to evolve in terms of the amount raised, the terms of the raise, the maturity date, there's only 3 or 4 terms you're actually fixing and papering, and you're not filing a charter with Delaware or Washington Secretary of State in black and white, concrete, hard to change terms. You're doing a contract, essentially a debt contract that can be changed if a majority agree to change it. So if you have your first investor or two and they're happy with these terms, but to get the next 100K, you have to change the terms, it's a much more flexible instrument to work with in terms of an evolving round where you're raising 100,000 now and 100,000 later, trying to get to some ultimate target of your initial round of financing. So just a couple of, there are a million different answers to that question, but those are a couple of ways that we guide founders to think about the structure of the first round of financing.
Great, thanks so much. Okay, so I'm going to jump into the next set of terms, and these are more closely related to raising equity. First is going to be talking about pre-money and post-money valuations. So Pre-money is going to be your company's, it's the amount that an investor and the company agree that the company is worth immediately prior to the investor's investment. And it's generally used for the purpose of determining how much the investor is going to pay per share for the stock that it's purchasing. So you can look at the pre-money valuation as just a negotiated number that is sort of a proxy for the company's value at that given moment in time. But it is important to note that that number isn't necessarily, a clearly calculated number that comes from certain accounting measures. Rather, it's often very highly negotiated, and it can be driven by market forces, and it is inherently speculative. So the pre-money valuation does have a significant impact on the size of the investor's ownership stake in your company, because the price per share that the investor is going to pay for the stock is calculated using a formula where it's pre-money valuation divided by the fully diluted capitalization. And that's what gives you your price per share. And you can see here we've listed what's considered in the fully diluted, which is in the denominator. And you have, your common and preferred shares. You have shares that are reserved for exercise of options and warrants, shares that are reserved for future equity awards. Those are in your option pool, and any shares reserved for conversion of notes and safes. So because your price per share and your pre-money value are going to be directly proportional, meaning when one goes up, the other also goes up, the higher your pre-money valuation that you negotiate, the more that your investor is going to pay per share for its investment, which obviously means fewer shares that they'll receive for that particular investment.
So just jumping in on pre and post money here. So the other really common question we get from founders is, what should my pre-money valuation be? As if there's some chart we can go to that has benchmarks on it and we can tell you with any kind of precision, it should be this number. It is very different in our startup world relative to a more mature company that has 50 million in revenue, where there are very clear, very tangible benchmarks that are very reliable and very useful to investors to dictate value. It's basically multiple of revenue based on growth. In a startup company, you don't have revenue, and you certainly don't have any historical growth rate to judge. And so if you asked us to run pull a set of data out of our client base, which we do all the time, and give you the range of valuations on a pre-money for a Series Seed, you'd see $500,000 on the low end and 50 million on the high end. And there's literally hardly a rhyme or reason to explain where the scatter diagram is of valuation. So what, again, what we would typically advise is there's a band of where most of these companies fall on a pre-money valuation, and that is, typically 2 million to 10 million. But you can go interview 50 of your friends and investors in this marketplace, and they would all give you an N that is in or out of that range. So to me, it's really much more about a negotiation process with your investors, potential investors, to tease out what valuation they'd be willing to invest at, and a function of alternatives that you create for yourself to either carry the company further to raise the valuation on a self-funding or a bootstrapped way, or having multiple investors who are willing to lead and write a check, and creating a little bit of sense of scarcity or competition that drives up that valuation. I wish there was a more concrete answer, but it really is much more of an art than it is a scientific data set.
Yeah, and the post-money valuation, put simply, is usually just your pre-money plus the amount that you raise in the financing. And then sometimes there are considerations depending on if you're increasing your option pool, or there are conversions of convertible securities that might be accounted for on a post-financing basis, then you would add those in as well.
So the big gotcha on post-money valuation that investors care about, and as a result you need to care about as a founder, is if the post-money is viewed as too high. And that is from a perspective of raising your next round of money. And there's a concept or a belief system in the startup world that every round you raise needs to increase be at an increasing valuation, right? So, so if you raise money at a 5 million today, your goal is to raise money at a higher valuation tomorrow, so that you've created some return on investment to your initial investors, and made the fact that they invested at a higher risk state of the company more valuable to them, because there's a risk reward ratio for the time of their investment and reward. So so if you get too far, if you push that envelope too far and set the post-money valuation bar so high, it really puts a lot of pressure on the company to outperform all expectations in order to grow into and exceed a valuation. And so there is sort of a natural alignment around investors and founders around a reasonable valuation that both rewards the founders for what they brought to the table, as well as one that provides ample room for the company to perform and to deliver and execute a business plan, and therefore achieve a higher valuation on the next round that will reward both the founders and the early investors.
Great. Okay, we're going to move into the next key term, which is talking about your board of directors. So the size of your board is going to vary, of course, depending on the company, but a good rule of thumb that we often provide for early stage boards is that the investors and the common stockholders representation on the board should somewhat reflect the controls of the cap table. So, if you have investors controlling maybe like 20% of your cap table, consider how that plays out into your board members. For a company that recently, completed maybe their first round of financing, we often see a 3-person board, maybe 1 investor representative and 2 founders as representatives of the common stock. As you grow into, your Series A, Series B, and you might have 4 or 5 members, you might be looking at, a Series A investor on your board, a Series B investor on your board, and then maybe 2 co-founders and an independent. And speaking of kind of having VCs on the board and also independents, there are kind of these 3 general categories of directors. You have your executive directors that are employed by the company, that run the daily business, so kind of your C-suite folks. And then you have your investor directors, and then you also have these independent seats that can help provide an external perspective with those folks not having direct ties to the company and kind of having that independent view. Go ahead, Sonia.
Sure, I'll just jump in on one of the most common questions we get from founders is around maintaining control of the board. And my advice is typically to not over focus on control at the board level. Control at the shareholder level is actually pretty important, because shareholders vote with the shareholder hat and self-interest. Board members have a fiduciary obligation to act in the best interests of all stockholders, not just the fund or the individual representation of their financial interests. So that gives you should give you hopefully some comfort that allowing more investors on your board is not necessarily the end of the world for you as a founder. It's also just a reality that a decision to go get institutional investment and outside investment is a decision ultimately to give up control of the board. It's very, very rare that a venture capital or institutionally funded company would ultimately retain control beyond possibly a seed financing round. I think, to Ashley's point, I think the independent directors are actually where the action is longer term, and that's what I would focus founders on, is having the ability to influence the appointment of independent directors, is where you can bring in members of the board who both provide a lot of experience, hopefully a lot of operating experience. Your investor directors sometimes have operating experience. A lot of times they're just financial investors. So bringing in folks who have actually done this before and have done it successfully and know the ropes of where you're going can be hugely valuable in terms of success of company and the idea. So, and they also tend to be aligned with aligned with management in terms of where the company is and where it wants to go, and can be great allies in that process and bring, as their name suggests, a true independence and outside view on navigating some of the sticky, thorny areas that are ripe for conflicts between financial investors and founders going forward.
Yeah, and the last point on here is just about voting agreements. And usually when you have financing, you'll enter into these contractual agreements amongst shareholders that will provide, for certain groups to designate board members. So that's where you'll get, for example, your Series A investor that may be appointed by the majority of your Series A holders. And that's usually where it's laid out how the board is going to be appointed. Okay, so now we're going to move into liquidation preferences. So a liquidation preference is essentially a right that one class of stockholders may have to be paid ahead of others in the event of a change of control transaction. So like a merger, an acquisition, sale of assets. And it's designed so that those investors get to receive their money back before any of the other, common holders get paid. And there are 4 primary features, related to liquidation preferences. You have the multiple, whether it's going to be participating versus non-participating. You can have a capped participating structure, and then there are kind of these different seniority structures that we'll also talk about. So the multiple essentially determines the amount that an investor must be paid back before the common shareholders are going to start receiving any proceeds. So it's common to see a 1x multiple, and that means that, for example, if your investor put in $1 million, they must be paid back 1x, so $1 million, before any of the common shareholders are paid anything. If we have a 1x and the company is sold for $1.5 million, that investor is going to be guaranteed that $1 million back no matter what. And then, the remainder will flow through. If the company is sold for $900,000, again, they are guaranteed their $1 million, but they only get the $900,000 in that case, and nothing is left over. You can have multiples higher than 1x, you could have 2x or even higher depending on the scenario, on market conditions. As the company, you're going to want the lower multiple because you want to have, the least amount of proceeds that are being designated for the investor up front. And it is pretty rare, especially here on the West Coast, to be seeing higher than a 1x liquidation preference, unless, they're being used in like down rounds, maybe where the company's value has decreased and they're kind of accepting harsher terms. But, if you do have a 2x multiple, the example would be from before, if they had put in 1 million, that investor has to get $2 million first, despite only having put in 1 million to start with, before any common shareholders are going to be paid anything.
So liquidation preference is a really key term. There are about 30 terms in a typical preferred stock financing related to setting the terms of that preferred stock that you're issuing to investor. And of all of them, this is the one that is worth spending a little bit more time negotiating and taking a little bit more of an aggressive, firm position if you feel like you have the leverage to do it. As Ashley alluded to, fortunately, over the last several years, the market has really come around to a pretty standardized position that is very favorable to founders, and we can only hope that the market sustains that, although watch out if there's a downturn. This is the first term that tends to degrade and go, move markedly towards investors. But a non-participating, a 1x preference, non-participating, meaning the investors get their money or they get their pro rata share of the proceeds, they don't get both, is by far the most favorable to the founders and is the current like 90% dominant structure, unless or until the company is in a more dire set of circumstances and is more desperate to raise money and has maybe stumbled a bit and is viewed as a higher risk profile, in which case we do see harsher terms, more unfavorable terms enter in.
Yeah, and to expand more on the non-participating versus participating. So with non-participating, the investor has the option to either exercise their liquidation preference or they could convert their preferred stock into the equivalent common shares and be paid a proportion of the proceeds based on their, equity ownership in the company. So, for example, if you have a 1x non-participating liquidation preference, if the investor put in $1 million and they own 20% of the company, and the company is sold for $2 million, they can either exercise their liquidation preference and get that 1 million back because it's the 1x, or they can choose to convert their preferred stock, into shares, which is the 20% of the 2 million, which is 400,000. Obviously here they're going to stick with the 1 million because that's better, but there is, the math of like, where does that threshold change and when does it make more sense for them to convert? Fully participating means that, and fully participating is less common, I would say, than non-participating, but it means that the investors, after they've been paid back their liquidation preference, they get to participate in the remaining proceeds in proportion to their ownership. So if they invested that 1 million and it's a 1x participating and they have that 20% ownership, if your company is sold for 2 million, they get that 1 million back. And then they also, on top of that, get 20% of the remaining proceeds. So it's almost like a double dipping into the pool of proceeds. And with participating preferred, they don't convert because they always have that higher value that comes from the additional, proceeds that come on top of that initial guaranteed liquidation preference. And then the capped participation is when you have a participating preference, but after the investors receive their initial preference distribution, they only can participate on a basis up until that cap is reached. And so that's usually phrased as a multiple of the original price per share. So you could have, for example, like a 3x cap, which would mean that they would get their initial preference back. And then if there's a 3x cap, that means they only get to participate up until the total amount that they've received is 3 times their initial price per share.
So very often, we always would advocate for starting in a term sheet discussion with non-participating. And once in a while, we have pushback on that, even in a Series C, Series A round. And the investors are, push back and ask for fully participating. And in my experience, cap ends up being sort of the compromise that you meet in the middle between, you convert if you're going to get a penny more than your investment amount, and you get 100% of both your money back and your pro rata, which is the fully participating. Cap sort of meets in the middle. The other thing I would say about this is that this matters to all companies. This really matters to companies that are going to raise a lot of capital. And I'll just pick on life sciences companies because they're the most obvious example of companies that will typically raise $50 to $100 million before they exit often. And these liquidation preferences, if you have $75, $50, $75, $100 million liquidation preference before the founders start getting any money back, it creates very high hurdles and can be very punishing to the common stock. So it is worth being pretty thoughtful about and being eyes wide open going into the discussion if the negotiation moves off of the non-participating format.
And on the seniority structures that I mentioned earlier, there's kind of 2 ways. You'll see sometimes that liquidation preference payouts, if there are multiple series of preferred outstanding, that it will be in order of like latest round to the earliest round. So for example, if the Series B get paid out first and then the Series A, so if there's not enough for the Series B to get their preference back, the Series A won't even receive their preference. So you can have them stacked in that way, but you can also have pari passu, which refers to all preferred shareholders across all stages having the same status, meaning they all receive a portion of the proceeds. Okay. So we're going to skip over this one just because we kind of went through a few examples, but that just kind of lays out an example of a participating preferred and how the payouts would look in different 1x and 2x. Okay. So we're going to move into option pool and founder vesting. So your option pool is essentially the number of shares that you've reserved to be available for future equity grants. And it's typically referred to as a percentage of the fully diluted capitalization of the company And often we're seeing, most times it's negotiated to be around 10 to 20% of the fully diluted capitalization. If you are trying to think about what should my option pool be, we often recommend kind of building out an option budget and thinking about, okay, what hires do we need to make over the next 12 to 18 months to meet your operating plan? And then you can present that to your investors. And that way, instead of just kind of, focusing on market standards and maybe they're just requesting 15% just to request that, you can explain, actually, we don't need quite that much. This is all we need. And that can give you some leverage as to coming to a final number for your percentage option pool. On founder vesting, so typically a standard vesting schedule is going to be a 4-year, 1-year cliff. So this means a quarter of the total shares will vest after 1 year. So that's the 1-year cliff. And then the remaining shares will vest monthly over the next 3 years. So this means that your grant will be fully vested after 4 years. And one thing we wanted to flag is that oftentimes, investors are going to ask founders to, possibly amend their vesting schedules just so that they're adequately incentivized to stick around. But usually you'll see some sort of credit that's given for, these contributions or the time that's been served, and it's often, for example, a year of credit. And other things to consider when you're looking at founder vesting is, acceleration provisions. There can be single trigger or double trigger. Single trigger acceleration refers to the acceleration of the vesting of your shares based on the occurrence of a single event happening. So oftentimes that's a sale of the company. And double trigger is similar. It's the same thing. Your shares get accelerated, but there has to be 2 events. And a lot of times we see that as the sale of the company and the involuntary termination of the employee within a certain time period close to that sale.
So again, one of the most common questions we get from founders is, why do I need vesting on my shares at all? I'm just going to have these fully vested and own them and earned up front, and that's how it's going to be. And that's obviously when at the beginning stage of the company, there's nothing wrong with you taking that position and papering your stock that way, and there's no one to push back. So, but for us, it's a strategic question for you to consider whether you're better off taking a position on vesting that might be more favorable to you than what you would expect to get from an investor in a term sheet. So it is highly unlikely an investor coming into the company is going to make their investment without a condition to their investment being founder vesting that they agree to. And if you let the investor dream up or design the vesting, it is probably more likely to be the standard employee vesting we highlighted, with 25% cliff in 1 year, and 4 years later you have your shares. We are very often able to hold the ground or draw a line in the sand where we have proactively put vesting in place that allows and gives more credit for time served, more credit for the founding contributions of the company, and try to limit the vesting to 2/3 of your stock is subject to vesting and over 3 years as opposed to 4 years. It can always be negotiated, but at least it's something that we think has a decent shot of prevailing and could end up being more, again, more generous and more favorable to you than if you just went in with no vesting. So on the acceleration, you both for employees going forward and for founders, this is a significant area of investor pushback. Investors, if you're selling the company, very often you're selling the team as well as the company. And so accelerating vesting takes away some of the handcuffs and some of the assurance that the company can give to the buyer that the key folks are going to stick around, right? Because all of the stock becomes earned and you can walk out the door with whatever that dollar amount is. And so we do see frequent pushback on acceleration for change of control. That said, single trigger is still reasonable ask for founders in particular, less so for employees or management, follow-on management. And double trigger is almost always acceptable because it bridges that gap. Look, if you want me to go with the acquisition, great. I've got my vesting schedule attached to that. But if you don't, and I'm going to be terminated or not invited to join the go forward company, then I should certainly get the stock and earn and get paid out at closing.
Okay. Okay, great. So we're going to move into protective provisions. So protective provisions require the company to seek approval from the investors before the company can take certain actions. So these can be set up as like a class vote or a series vote. Class meaning that maybe you need a certain percentage, like a majority of all of your preferred stockholders to vote together in order to approve a certain action. Series would be a specific series. So maybe you have your Series B stockholders, a majority of them need to approve certain actions, and you can have them set up, where different series have to approve different things, even though a lot of times they do track pretty similarly. And sometimes when it is set up in the separate series, we will include provisions that allow for that type of protection to terminate if a certain number of those shares are sold and so that they're no longer held and outstanding.
So one of the analogies I use on protective provisions and class or series voting is how many guns do you want to hand out to the shareholders to hold up a deal? And so a class vote is always going to be better because you're handing out essentially one gun to a group of preferred to agree on whether they're going to use it or not. Handing them out by series means that every investor is going to have a separate veto to hold things up. And then this goes back to our original point on control of the company. This is the control that matters. You should presume as a founder, if you're going to raise substantial amounts of money from investors, that you're not going to maintain a majority of the stock going forward. And even if you do, your investors are going to insist on these separate votes that they have to block things that you do going forward. And so this really is, think of this as a veto right. They can't affirmatively approve anything without a majority of the stock, but they can hold things up. And so to sell the company, to increase your option plan, to do another financing, all of those things, which is a good lead into our next slide, end up requiring the investors to agree to go along with.
Yeah, and as Sonia mentioned, there are lots of different types of protective provisions, and those can be negotiated very specifically, but these are a lot of the common ones that we see, whether it's like amending the charter, authorizing a new series, so for your next round, selling the company, changing the number of members on your board, things like that. Okay, so drag along rights. These enable the majority shareholders to drag the minority shareholders in an acquisition. So this can be useful in situations where a potential buyer wants to purchase 100% of the outstanding shares of the company, or for example, in a merger transaction, a lot of times buyers will demand that a certain percentage of the stockholders vote in favor of the acquisition. And so this provision is used for that purpose. It's essentially a tool that avoids a situation where a handful of minority stockholders can hold up a transaction that has otherwise been approved by the majority of the stockholders. And so the important thing to look at with a drag along is going to be the voting threshold that's required in order to trigger that provision. So oftentimes you'll see that you'll need a majority of the preferred stockholders, a majority of the common stockholders. A lot of times it requires approval of the board as well to approve the trigger of that drag. And there can be certain nuances to the way that the drag along provision is structured. And it's really important to look closely at that to make sure that you won't end up in a scenario where maybe your preferred, who have a better liquidation preference, are going to try and drag the rest of the stockholders into an acquisition.
So the first thing I would say about this is drags are 100% standard. So the idea that you're going to be able to push this out of your term sheet and get money from investors without it is probably unrealistic unless you've got a super amount of leverage. That said, there's a lot you can do and should do in negotiating it to make sure it operates in a way that doesn't unduly cut out the common stockholder vote, common stockholder considerations. So, and the two that in order priority are to make sure that there is a board vote required to invoke the drag, because the board members have fiduciary duties in a way that the stockholders don't. So number one is getting a majority of the board to be a requirement for the trigger of this. And the second, which isn't always possible, but at least worth trying, is to get a separate majority of the common, so that you have both a majority, this threshold of preferred, and a separate majority of the common, so that the common actually have a seat at the table, if that's possible. So those are my two additional thoughts on drag-alongs.
Great. And our last term here is going to be right of first offer and right of first refusal. So the right of first offer is basically if the company is going to issue new securities, the existing investors have the right to make an offer to purchase those shares before the company can go issue them to someone else. So you can kind of look at that as just a way to protect against dilution. You know, they can ask to maybe participate and maintain their pro rata share before the company goes and issues those securities elsewhere. Typically, there's going to be some carve outs, you know, like if there are shares that are being issued upon maybe like conversion of preferred, or that shares being issued to service providers, issued to banks in connection with like a debt, you know, financing. But those are kind of standard carve outs, and often this will also terminate upon like an IPO, sale of assets. And then there's also the right of first refusal, or yes, right of first refusal, which basically requires shareholders who want to sell their stock to give, you know, the company and current investors the right to purchase those shares first before another third party can purchase them. So this helps to control founders from selling their shares to third parties. There will often be carve-outs that we want to include for, you know, like estate planning, gifts to immediate family, things like that. Sometimes you'll see exclusions of, you know, if they sell 5% or less of their shares, then those types of sales will be permitted and not subject to the right of first refusal. But those are kind of things to look at and see how the founder shares are restricted.
Yeah, and just a general comment on this. This is just a standard term in our venture world, where there's a lot of concern about keeping control of who's on the cap table while the company's private. Obviously, the company goes public and it's a totally different ballgame. But while it's public, there's an interest in making sure that there's some control and some checks and balances on who holds shares in the company and who has rights. And so this is in the spirit of that.
Great. And that's it. We can do some Q&A now.
Great, thank you so much. Yeah, we have a few great questions actually. In terms of the class and series, Mike Murphy is asking, once the choice is made between class and series, does that stay the same forever?
Yeah, so is this in connection, likely maybe with the protective provisions that we were talking about? When we're talking about how that can be separated in class or series, that can be changed. But I would say that when you start giving maybe like your Series A certain protective provisions, almost certainly your Series B is going to ask for that. And so, you know, you have to think about setting that precedent. And that's also a good way to talk to investors about not giving certain provisions, you know, reminding them that maybe in the future, they're not going to want other series to have that type of control as well. So something to consider early on.
Yeah, and just to use a great example of that, I have worked with a company that's on its Series J, which is pretty uncommon and not necessarily their original goal. But they have, you know, at this point, 20 major investors who have come and gone and continue to invest in the company. And if we'd done a series vote, we would literally be looking for 30 different individuals. It'd be like Congress and trying to get something through the Senate where everybody has to agree. And they're very happy that early in the Series A, they decided to do a class vote and have stuck with that the whole way through, and have always looked around the table and used it as an intra-investor point that we're locked in this company together and we want a majority of the investors to form a consensus and not have any individual investor, whether you were early or late into the syndicate, have a veto. And it's been a very, very successful. And that's one where, like, a lot of things that we do and negotiate need to be looked at in hindsight, you know, in this case, almost 20 years later in a company's history, through thick and thin and ups and downs, to make sure that they work. And I would say that blended approach has worked really well.
Great. What are the pros and cons to using phantom stock in incentive plans?
I have a lot of cons. Somebody else might be able to come up with a pro. But look, phantom stock is extraordinarily complicated from a tax perspective, and has, if not done exquisitely well, has a tremendous amount of downside consequences as the company goes through different iterations. I would also argue it's just not well understood on the street. So I'm not convinced a company gets much value for its phantom stock shares. And so if the goal of those plans is to attract and retain and motivate employees and service providers, I think it underdelivers significantly, because in my experience they're too hard. They're not common enough. People don't understand them. They can't go out and talk to their friends about what it means. And they, I don't know if anybody's read one of those plans. I have, and they're almost impossible to digest. So I guess the pro, just to be fair, I think the pro is that they're not actually equity on the cap tables. So they don't come with the voting rights and the same shareholder rights that some of the equity plans do. So from that perspective, I think that's why, I assume that's why folks introduce them and use them in some scenarios.
Great. Thanks for balancing that out. Way to find the pro. This is from my colleague, Magli. When it comes to boards, men-led companies receive much higher valuation, 73% higher than women-led companies on their first round of funding. Do you have any advice for our women entrepreneurs raising a first round?
That is a terrific question, and so close to my heart as we've watched this industry struggle to come up with any plan to execute against the awful numbers that we see every year on female founders. I guess the only benign explanation I could come up with, a lot of bias and a lot of discrimination and a lot of unfairness, and I think that's the prevalence. I'm not going to defend the industry at all. I think the one benign is, there is an experience issue that where our industry, venture industry, has arguably over-rewarded, over-relied on, over-calibrated experience as a metric of success and validity and worthiness of a business plan. And obviously, if the industry's always been dominated by men, then they bring to the table a higher average number of years of experience. That said, I'm an optimist, and I'm internally optimistic that we're figuring this out slowly, and that there's been a lot more attention on this issue and a lot more folks, including old staid venture capital firms, who are worried that they maybe have been biased and are a little bit more aware of it and are trying to unpack some of those layers and bring to the table a more a little bit more fair lens on, is this just a plan that's worthy of investment and worthy of value, without regard to over-indexing on some of the things that bias against women. We also have a lot of funds that are getting funded around the principle of only investing in women and diverse founders, and I think that's a way that's catching fire, and I'm super happy to see that. And I think anyone who looks at the data is super clear that there's a higher success rate correlated with female-founded companies and underrepresented founder-funded companies. In part, probably because there's been so much money chasing white men that anything that's bubbled up to the top is by almost definition higher quality, because you've had to go through so many more revs to get to success. But I also think it's just recognizing, like, there is their diversity adds to success because it adds to the diversity of ideas and the diversity of lenses that are brought to the solving real problems in the world. So I'm hopeful.
Thanks. Yeah, hopefully it's a good momentum change.
Yes.
Yeah. Gary Rittner asked, what is the typical compensation for an independent director?
So in a private company, the typical director compensation is not cash-based unless the company is very mature, on the very mature side of the spectrum. It's option or equity-based, and it typically runs 0.2% of the cap table to 1% of the cap table, and some outliers that are above 1%, likely because there's a pretty fulsome role there of more executive chairman, a founding contribution towards the business plan, the Rolodex introduction to key strategic players around the company. So, but I think on average, you would see 0.5 to 0.75 as an average with vesting. So, and sometimes the vesting is less than 4 years because the terms of directors tend to run 2 to 3 years with some succession built in. And so often with 2 to 3 year vesting on that grant.
Peter, I think this is in regards to maintain control, which has come up a couple of times. Peter asked, can you share any recent examples of pre-seed Series A companies having higher degrees of leverage, maintaining uncommon amounts of control during negotiations?
Yes. Again, I want to emphasize, I think it's a real outlier to maintain control across the gamut. So shareholder control is not uncommon, right? That's a function of valuation, whether you sell a majority of your stock or not, and maintain some control as a shareholder. Board control, we definitely see that sometimes, especially in the early rounds where the investors aren't necessarily looking to control the board. They just want they probably have some protective provisions that guide, give them a voice on certain very key decisions that they care about. And so I think, yes, it's possible. And then you get to the outer limit of like, I'm going to control everything. I'm going to control the shareholder votes. I'm going to control the board. I'm going to control all the decisions. I'm not going to give up any voice to my investors. And now you're in an N of 1 or 2. And better make sure you've got the leverage. Everybody points to Mark Zuckerberg as the example of somebody who today has super outsized control on Facebook, and that is all true. But I'm not sure that's a relevant data point for all but a very, very, very few startups to use.
When it comes to liquidation preferences, Mike is asking, what conditions lead an investor to push for fully participating?
For an investor to push for it, fully participating?
Yes.
Well, yeah. So, I mean, they would financially be incented to push for it all the time. But if the question is in the cases where they actually push for it because they think it's merited relative to the 90% data set that has of the market that is accepted non-participating, I think that is more common where you've got investors who are where there's probably a low capital amount raised that's budgeted, and so there's not as big an impact on the founders, because if you're only going to raise 5 million, it's not a super big give to give participating preferred, because the dollar amounts just are de minimis and it doesn't change the cap table that much. Ashley, can you think of any other situations where we would actually think fully participating was merited versus they just happen to have the leverage to get it?
Yeah, that's in my experience, it's more so like a leverage point. But I agree, like the smaller the investment amount, then you have the smaller amount being taken off the top. And so that participating concept isn't as like detrimental to the common shareholders.
Yeah, I think every once in a while you get somebody who's like been living in a cave for 20 years and didn't notice that the market had become so dominant, and they come in and just assume fully participating, and they won't back off of it, and their lawyers will back them up and say, oh, we always get fully participating. And so we do lose some of those because you just are, worn down and can't move them off of it, and the company needs the money or wants the money, and so you accept it. But with rare exceptions, we tend to hold pretty firm on non-participating.
Okay, I think we have a question in the room where people are watching. Let's see, it's coming through right now. I'm gonna connect them with you
Okay.
rather than go through this. Before we end, would either of you care to share, like, is there a common mistake that founders make when starting a company?
Sure. I love to get ahead of the issues. So capitalization is by far the single biggest mistake, and it's on two fronts. It's one, it's on the substance of it. Just you're a founder and you're excited and passionate about your idea, and you've got what feels like a blank checkbook that you can just start writing promises and commitments for sprinkling around stock to everybody who looked at your business plan or said they had it, wanted to contribute to your idea or showed up to a meeting or two. Pulling back stock is really hard. It's like any entitlement, right? Giving something and then trying to get it back, really, really tough in the world of political consequences and emotional consequences. And investors really, well, you should care because you're a founder and you want to reward the people who've actually contributed to the company as opposed to people who came and went and didn't really leave much of value behind. Even if you don't and are predisposed to be more generous, your investors truly care, and they will not love seeing a cap table. And in fact, it can kill your deal. They won't invest in a company where a cap table is littered with a bunch of people that nobody has a really good answer for. Well, what did they do and why are they on your cap table and how come they hold that much stock? They want to see a clean cap table that has 2 or 3 or 4 or 5 founders, whatever the real team is, that is there and committed to the next 4 years or beyond to build and execute the business plan, and they can see tangibly how that team is going to do it. And it can be a real poison pill to have 4 or 5 names where the answer is, well, they helped us early on and, they were nice and I felt bad and I gave them some shares. So I would be very thoughtful about that. And then the other mistake is on the technical side, and as at the risk of shame, like a plug for us or our profession at least, not having lawyers who know what they're doing involved early and papering this with right from the very beginning. And CAP is a great example. There's many examples. Everything we talked about today is an example, but CAP is one where you literally sometimes can't fix it later because of the tax consequences. It's a very complicated securities and tax laws that govern it. And so getting it right and papering it right and having lawyers who know what they're doing involved from the get-go is critical to not ending up 2 years from now with investors ready to write checks and they literally can't because you can't pass diligence because there's too many liabilities on the cap table, tax and securities violations that they can't finance around and they can't fix. So.
Great. Well, that's all the time we have for today. Thank you for joining us, everyone, at home, at the office, in the Idea Lab. And thank you, Sonia and Ashley, for taking the time to share your wisdom with all of us. As a reminder, next Friday at noon, we'll be hearing from Tamina Watson, who will present immigration options for startups, current laws, and new developments. Sign up for that. We'll see you next week. Bye.